Welcome. My name is Arunma Oteh, and I'm executive in residence at Saïd Business School, University of Oxford. I'm pleased that you're able to join us via various social media platforms. This is our 26th live webinar in this series, Leadership in Extraordinary Times. The series was created by Saïd Business School as part of its response to the COVID-19 crisis. As you know, the session will be a debate that will review Professor Phalippou's upcoming research paper, which assesses the fees charged by general partners in the private equity industry. It has a fascinating title, An Inconvenient Fact: The Private Equity Industry and the Billionaire Factory. I hear it has caused a stir online. This topic is a very important one, particularly because many pension funds, who pensioners around the world depend on, endowments, sovereign wealth funds, and other entities that manage public funds that impact society, have to depend on private equity funds. For example, as World Bank Treasurer from 2015 to 2018, and amongst other responsibilities, I had oversight of the World Bank Group's 27 billion pension portfolio. My team and I invested the funds through over 200 fund managers, many of whom were private equity fund managers. I saw firsthand both the diversification opportunities that PE funds provide and the immediate impact and value of any savings and fees. This is indeed a very important issue. Let me tell you how this 1-hour event will be structured. Ludovic Phalippou, Professor of Financial Economics at Saïd Business School, University of Oxford, and author of this research, will present the case he makes. David Robinson, Professor of Finance at Duke University, will present counter-arguments. After their presentations, we will take questions, including from participants. So please use the chat function on the platform that you're on to share the questions you want answered. After the Q&A, I will ask Chris Flood of the Financial Times, who has covered this industry and this topic extensively, to give us his perspectives. In the same style as with Oxford Union debates, the House believes the PE industry loots our savings to mint billionaires, and that should be stopped. Now let me hand over to Ludo, who's proposing the motion. Thank you, Ludo.
Thank you very much. I hope you can see my slides. So that's indeed the motion that is being presented. And let me start with some facts. The funds raised between 2006 and 2015 together returned $1.6 for every dollar they invested as of the end of 2019, which is the latest data we have. Our pension funds and endowments would have earned the exact same amount by investing in American stocks. But that private equity performance is similar to that of public equity maybe is not that shocking. It is certainly different from what every single marketing brochure says, from what we hear again and again and again in any industry presentation, that's for sure. And it is certainly not why pension funds, college endowments, and the like are paying consultants for, are providing free liquidity at short notice for, bear all kinds of extra internal costs for, pay armies of lawyers, etc. But here is the most shocking fact. The carry payments that have been made to these very funds as of December 2019, the carry due is 230 billion. Now, to be clear, carry payments are not supposed to cover any sorts of operational costs. It is a cash reward for good financial performance. But of course, we do not know the exact figure. some pension funds have just started to collect this information over the last 2-3 years, and what they collect is typically incomplete. I don't think college endowments collect this information at all. So this is an estimate. This estimate is based on mostly conservative assumptions. But most importantly, there is more carry than that, paid even after 2006, because all the previous vintages collected carry as well, 2005, 2004, etc. If I were to add these older vintages, I would reach the number of 370 billion. And if I add to the US the rest of the world, I would cruise past $500 billion mark. Again, we are talking about cash payments to individuals for good financial performance. And we are talking about $500 billion. And as a side point, note that these payments are taxed at a much lower rate than income is in most situations. In some states, you can just pay 20% on this. In the UK, it used to be 20% as well. And today in the UK, it's 28%, much less than income tax rates. If that is not called looting, then I don't know what is. If that's not the most extraordinary wealth transfer of mankind, then I don't know what is. And the perfect irony is that private equity is marketed as alpha clause, which I picture here for you so that you have a visualization. What we hear all the time is, if your pension is under threat, no problem. Alpha clause is here for you. All you need to do is invest more in private equity. Your university tuitions are ballooning, no problem. Alpha clause is here for you. Just invest in private equity. But it is Santa who's driving the Ferrari, not the pensioners, not our students. The fact that not only Santa didn't deliver the presents is quite bad, but on top of that, it became a billionaire on the way. And that probably adds some insult to the injury. And this state of affairs hurt a lot of people. It widens wealth inequalities. And I think it is increasingly apparent, even to economists, that a society with massive inequalities cannot function. And it is worse than this wealth is hard to justify. Even if you are comfortable with the pay for performance mantra, which I'm not, but even if you are, here there is not even performance to be rewarded for. There is absolute performance, but the value of all American equity went up. And if private equity performance is going to be poor going forward, most of this money will not be returned. The $500 billion will be gone. It is head, I won, and tail, you lost. How can we accept such contracts? How can we not ask for this to stop? And I will go further and argue that stopping this is for the good of the industry itself. Any industry needs a license to operate, and probably even more so nowadays than ever before. It's not even nice to be a billionaire in a society where people think you have stolen your money. It's not nice, nor do I think it's really fair to them. Most of them are hardworking, highly knowledgeable and individuals, and they can contribute a lot to society. We need them, they're useful people. It is also hurting the 95% of the people working in this industry who are not billionaires. There are tons of people out there working in smaller private equity firms and for whom it is difficult to make ends meet. And the key reason for this is that the model is very expensive. So the model needs to change, but the model cannot change if people do not acknowledge the facts that I've just shown you. Because if people believe in alpha clause, then there is no need to rethink the model. The model is great, so let's not think about it. But that's not the situation. I love private markets, I love pension funds, and I love endowments. But think of it as tough love. I think they have a future. I do not think public markets are a modern solution. They are not even available in most countries. The future is people controlling companies in order to change the companies for the better, to help society. Only private markets can do that. And this noble effort should not be hindered by absurd compensation schemes on top of absurd taxation schemes. This noble effort should not be hindered by allowing imposters to use all kinds of window dressing techniques to make people believe they are some kind of miracle workers. We need to close all the potentials for conflicts of interest. We need a level playing field. We need standardizations of contract and of performance disclosure. That will lower the cost of the model. And there are many people working on different models, but they don't get traction because it is still believed that it's Santa Claus, so we don't need to rethink the model. These people need help. These people are on the right track. We need sustainable private markets. And this is why I urge you to vote in favor of the House motion.
Thank you, Ludo. Let me hand over to David for the counter position. David, you need to unmute yourself.
Let's try that again. Thank you very much for having me. And thank you, Ludo, for the opportunity to debate with you on these important questions. Ludo's just shown you how expensive private equity is and has argued that its relative performance against public markets has been quite modest in spite of these high fees. I certainly agree with Ludo that private equity is an expensive form of activist investing. But Ludo skips over what private equity has actually done for the economy and for society in earning that carried interest. Oscar Wilde said a cynic is a man who knows the cost of everything but the value of nothing. Ludo is certainly the cynic here. Let's talk about the rest of the story. Here are some facts about private equity performance that are indeed inconvenient facts for the argument that Ludo is advancing. First, let's talk about patenting firms. Patenting firms become more innovative, not less innovative, after being acquired by private equity. They don't file any fewer patents, and the patents that they do file end up having higher impact. Private equity-backed firms in the United Kingdom were more resilient during the global financial crisis than similar firms that were not PE-backed. Private equity creates as many jobs as it destroys. Yes, job losses go up in underperforming divisions inside private equity-acquired firms, but hiring also goes up in well-performing divisions. The latter outweighs the former. Moreover, employees that remain in PE-acquired firms build human capital faster than employees in similar non-PE-backed firms. Bottom line, PE-backed firms have better management practices. We're not talking about anecdotes here. We're talking about comparisons based on thousands of firms across 34 countries. These better management practices end up creating efficiencies inside firms that benefit not only shareholders, but also employees and customers. Indeed, workplace injuries go down after facilities are purchased by private equity firms. And I'm talking by a lot. If you took every workplace in the US and you made it safer by the same degree, we'd have 800,000 fewer workplace injuries in the US every year. Look at fast food restaurants. Fast food restaurants got cleaner, healthier, and better maintained after PE acquisitions. I'm not talking about McDonald's versus Burger King. We're talking about comparing a private equity-owned location to a franchisee owned location of the very same chain. And we're not talking about one chain. We're not talking about an anecdote. We're talking about 3,400 restaurant locations across 118 restaurant chains. Firms do a better job reaching customers. After private equity acquisitions of canned food companies, we're talking about the stuff on grocery store shelves, revenues go up. Revenues go up, but not because the private equity-backed firms have raised prices, but because they've expanded their product offerings and their geographic reach. I could go on. And in fact, I will post citations to back up each of these statements to my LinkedIn page later today. But the point is, private equity does not mint billionaires by robbing our savings. It mints billionaires by making companies better. Better for shareholders, yes, but also better for customers, better for employees. Every time $1 billion of carried interest is generated, $5 billion of net returns have been created, $4 billion of which have gone back to our savings coffers. We can all point to individual anecdotes that put the industry in a bad light, but it's dangerous to extrapolate from that to a general theory of what's wrong with PE. And that's a critique that I would levy not just against Ludo's proposition, but in fact against a broad range of policy initiatives in the US and abroad. The second part of Ludo's argument is that their performance, the performance of private equity, has been only modest relative to public markets. The conclusion we're implicitly being asked to draw is that PE managers are somehow resting on their laurels in spite of their enormously high-powered incentives to do otherwise. First, I just want to point out that by connecting average performance to the sum total of performance-based compensation, this argument overlooks the enormous variation in performance that we see in this market. The spread between a great manager, a good manager, and a weak manager in private equity is enormous. Orders of magnitude over what we experience in public markets. But let's take a more granular look at this statement. I want to make 3 quick points here. First of all, Ludo's very own numbers, the ones that he's reported in his report, conflate traditional buyout with real estate, infrastructure, and other types of private capital when he reports that the big 4 have only just beaten public markets. If you look more carefully at his own numbers, you'll see that the buyout funds have reliably outperformed public markets during this period. But let's put that to the side. Second, even if we accept that private equity has only barely matched public markets since roughly 2006 or so, it's important to point out that the broader view of history tells us a very different story. My own work with Berk Shensoy at Vanderbilt University has shown that buyout funds have earned about a 3% per annum excess return over the very long run. That's a number that's been confirmed in a number of other studies. Similar numbers have been reported by Bob Harris, Steve Kaplan, and Oxford's own Tim Jenkinson using different data sources than the ones I used. So why then? Why is it that this post-global financial crisis period in public capital markets has been so different when we think about the comparison of private equity and public equity? Since 2008, we have seen unprecedented levels of central bank intervention in public markets. This quantitative easing, which has been conducted on a coordinated basis by central banks across the globe, has pumped trillions of dollars into capital markets, and this has fueled the longest bull market in history in the US. So instead of looking at public markets and private markets and concluding that private equity is somehow Alpha Claus who's stolen our Ferrari, why aren't we recognizing that central bank intervention has placed a giant thumb on the scales of this relative performance comparison? This brings me to my final point of my argument. Why is it that private equity has outperformed public markets so consistently throughout its history? Here's where Ludo and I agree. There's no alpha clause. It is not because it offers a free lunch to investors who are lucky enough to be invited to get on board. As I said, the spread in performance between the top and bottom quartile funds is huge. Private equity outperforms public markets on average because investors in private equity are bearing liquidity risk. They are bearing risk in addition to the risk that they face in public markets, and they're compensated for it on average. Not just we're talking about the risk that an investor will be asked to provide a capital call when they are ill-equipped to do so. This illiquidity premium over the long historical period carries an excess return. So to conclude, private equity has minted billionaires, yes, for sure. But this has come at the benefit, not at the expense of our collective savings. Perhaps it is outperformed public markets somewhat less dramatically since the global financial crisis, but let's not forget that this has been the longest bull run public markets have ever seen, and that is due largely to central bank interventions. I think that if you think the next 12 years going forward in public markets will look like the last, then I think you should vote in favor of Ludo. But I think if you do, you ignore a wealth of macroeconomic evidence to the contrary. Thank you.
You both have made very passionate and compelling arguments. I would like to start the question and answer segment of this very important series by having each of you ask the other some questions. But before that, I want to encourage everyone who's sharing this opportunity on various platforms to keep the questions coming. I will try and put them together and share them with Ludo and David. David, let me start with you. Do you have a question for Ludo? Do you have questions for Ludo?
I do. Let me begin and thank you. So Ludo, I want to be constructive with my question because I agree with you when you say that private equity needs tough love. And I think you make an interesting point when you point out that during this long period of public market return, strong bull returns, it's been easier perhaps to generate good returns in private equity. So yeah, maybe private equity's been sailing with the wind at their back during this last bull market run. But you want to fix that by blunting their incentives to create returns. And so what I want to ask you is, would you instead be in favor of changing limited partner agreements so that general partners did not begin earning carried interest until they exceeded a floating market-based preferred return, instead of what we now have, which is customarily for general partners to begin earning carried interest after a fixed 8% return? Would you be in favor of a proposal like that instead of one that blunts their incentives to create value?
Thank you for your question. I've written a piece available on ssrn.com on my page that said modifying the carried interest to do what it says it's supposed to do. But if somebody wants to stick with a carried interest mindset, I think that I'm not even sure that we need this carried interest obsession, and we certainly do not need asymmetric contracts. These are like very dangerous contracts. Imagine like you take Blackstone, they have had a lot of carried interest earned, they have delivered high returns, I guess, but what if all of their funds now are not doing well? They're not going to give the money back, right? Of the previous funds. So it is like a very tricky system, this asymmetric compensation. And this idea we have that like we need to give people like all these incentives, otherwise they're not going to work hard, they're not going to like do great things. I don't know. I work hard for my MBA students to prepare my lectures, etc. And I don't get like an incentive fee for doing that. The nurses at the hospitals are doing a great job. And even though we're not telling them, look, if there is one more person that dies of COVID less, then you will get 10,000 extra. I don't know why we have this obsession with like having a carried interest. So I don't understand why not everybody just works on the basis of, just reasonable compensation and doing the best we can. And so if we go onto that route of saying, you absolutely need a carried interest, it could be an absolute one, but then it needs to be designed differently, whereby somebody really take a stake in the company and earns whatever is there at the end of a year. So if somebody like takes like the own investments in a fund that I have no problem with, right? You make your own investments in a fund, the fund does well, you do well, fund does badly, you do badly on your investments, is okay. The carried interest is different, so that you get it if it goes well, and then nothing happens if it goes badly, and that's a bit tricky for limited partners to have a portfolio of options, right? If you have these private equity funds, you are buying a portfolio of options, and that can be extremely costly, especially when there is lots of volatility. So this heterogeneity that you just described is a killer when you have a basket of options, right? And so that, I think, is what is really, really tricky. And it's a question to be answered that you raise that is very good, which is we don't know if without these billions, like they wouldn't bring all these benefits to the society. I tend to think that people are good people and they would work hard just like I do, like you do with our students, and we'll deliver that anyway because they will think it's the right thing to do. But we don't need to give. I mean, we are talking about staggering amounts of money. We're not talking about some good reward. We're talking about extraordinary amount. So
there's no question that we're talking about sums of money the likes of which you and I will never see and we'll only read about. And I totally agree with you that the world is filled with good people who work for the intrinsic motivation that they of seeing good come from their actions. But if you go back and you look at the early studies in the 1980s, you looked at like the percentage of how did the CEO's compensation change with respect to changes in the underlying company's value. Hall and Murphy, these earlier papers were finding it was like 2 or 3%. Then you bring in private equity operators who have much stronger incentives, and what do you see? You see tremendous changes in corporate behavior. And I agree that it is, I mean, we can all come up with examples where there are bad outcomes, but on average, that has generated tremendous amount of efficiency that's benefited shareholders and the entire rest of society. So I think it's important to remember that, yeah, we're one person is getting, or a few dozen people are getting billions of dollars, but millions and millions of people are made, better off as a result. And that aggregation, I think we're blind to that aggregation when we make this comparison.
I'm relatively sympathetic to the arrangement of the management teams if it's structured properly. And so the paper I was just mentioning on modifying the carried interest to do what it's supposed to do is to say that the GPs with the LPs would sign the same contract that the management signs with the GP. It's not quite the same. It looks a bit the same, but it doesn't have the same incentive effects. So if really one was saying like, we really need this incentive effect, again, I have doubts about that. But even if one says like, we really need that, there would be a more natural way to write it. The current contract between an LP and a GP is not, it's very hard to justify from even that standpoint.
Ludo, I may come back to you for your own question. I've got a lot of interesting questions coming from the various audiences on various platforms. We have people from everywhere, from India, from Israel, from Holland, from Italy, from the UK, from the US, and many other places. But I wanted to, Ludo, have you respond to Adam Lee's question. We came from our YouTube channel for you. It says, why do you feel, and I think you touched on it, but maybe you can be more specific. Why do you feel the pay for performance model is not a good one? Also, would you still take issue with PE if the compensation model was reduced from 2 and 20 to say 1 and 10 or 0.5 and 5? Since we're on this issue of compensation.
I think the answer is similar to what I told David. I'm not sure we need any carry really, but even if we have some, yeah, it's more the fact that it's asymmetric that bothers me. In a sense, I don't mind somebody who has like 50% carry, but it needs to be symmetric. So if people say, you know, if things go well, I get half of the apple, and I say, okay, and if things go badly, you give me the half of the apple that you stolen from me. It's like, it's either you think that the world is deterministic or you think it's luck. If it's luck, there is no need of this carry thing, right? Because it's just like lucky guys and unlucky guys. We don't need that. If you think it's deterministic, but when somebody delivers you 20%, it's like due to their skills purely, and therefore they are entitled to, let's say, half of that, then it's fine. But that means that if they lose 20%, it's also their fault. So it's either deterministic or it's luck, but it cannot be like deterministic on the way up and bad luck on the way down. So if people want to say, look, I take 50% of the returns, and if it goes up, I take 50%, but if it's on the way down, I give you back 50%, then fine. But that's not how the contracts are structured. So I think I have more issues with the structure of the contract.
David, your view. But also, there is another question that Toby Mishnell asked, which is, would the problem be solved by linking the performance related elements
this is what David said,
public markets benchmark rather than a static 8% hurdle rate? So
David, I think we could have with like an upper cap and a lower cap. I think it would make sense, because to go back, we'll probably touch again on that question that David raised, like, oh, the last 10 years have been exceptional, right? Or last 15, now it's 14 actually. So when private equity, imagine the way we think about benchmarking in academia is that we think of somebody being passive, like a monkey. That's usually how we portray it. So we say, you just buy a company, you hold it for 4 years, you don't do anything, and then you sell it back. When you buy it at a price multiple that is similar to what publicly traded companies trade at. And when you sell it, it's the same thing. So if a stock market went up by 50% over the 4 years you held this thing, if you hadn't done anything, you would have gone up by 50%, right? So that's why we usually think that indeed, you know, if you want to reward someone, again, if you believe in this, in that sort of world, then it's much more natural to take a close public market equivalent if there is one out there, right? So in the US, there are lots of mid-cap companies that are traded, small-cap companies that are traded. And so for leverage buyout, it seems like a very natural benchmark to use indeed. So you could have at least part or with some bounce below or above, but something linked to public markets indeed.
David, what about your perspectives? And I think the issue around benchmarking is probably one that we should take next. So the question about that. But
let me just make a couple of comments in
reaction to those
Ludo said, because I think this is very interesting, and I think this is an important discussion we should be having. So first of all, you know, I think Ludo's point is very interesting, that you need to take a stand on whether it's luck or determinism that's generated this performance, and the way you think about compensating it is going to depend perhaps on which model of the world you have. Where I would push back on that is that I think it is a combination of skill and luck. And I think we set up incentive systems on the front end, and we have to live with the consequences of them on the back end. And there are certainly going to come at the end of the day, when the settling up occurs, there's going to be performance that's paid for luck, but there's also going to be performances paid for skill. And so I think I agree that it's fruitful to think in terms of this distinction between skill versus luck, but I think we have to acknowledge that we live in a world in which the two go hand in hand. And the reason I point that out is because I think it ties immediately into this next point about this relative performance, this benchmarking. It has been, as Ludo quite correctly points out, it's been quite easy to make an 8% return in a market that's been delivering consistently more than that for quite a long time. So that's what I meant when I said in my question that, private equity's been sailing with the wind at its back. But let's think about why that is. Once you acknowledge that the premium that you earn in private equity is a liquidity premium, then it makes perfect sense, because we're standing in the shadow of the largest liquidity intervention in human history. Is it any surprise that the liquidity premium in the current period might be lower than the long run historical average? So I just think it's important to take that perspective on this issue. I do think that it would be fruitful to think more carefully about the appropriate ways of benchmarking these things. And I'm quite enamored of this idea of replacing a fixed 8% preferred return with something that floats relative to markets. And I think, of course, the devil's in the details here, and you'd have to think very carefully how you'd implement it. You probably want to implement it on a capital call by capital call basis. So each time a limited partner made a capital call to a general partner, that capital got marked at the current value of the agreed upon index, and compensation was paid after that index value was settled up against. I think you'd want to be very careful how you did that. But I want to push back on this idea that we want, because levered buyouts look a certain way, we want to move away from a broad index and pick like a small growth index as the reference point, because I think we also want to think about the opportunity cost of those capital calls, and where do many large institutional investors draw the capital to meet the capital call. A lot of times they do it by just adjusting their position in a broad public index, because that's the place where you can raise capital that has the least price impact. And so I think when we think about designing performance measurement systems, we want to think, yes, about the risks that you're bearing in relation to what you could be bearing elsewhere. But I also think you want to bear in mind the underlying funding costs that the LP is facing. And I think that moves you towards a broad index rather than a narrow index.
David, but maybe you can also, Neil McDougall, who's chairman at Silver Fleet, asks a question about benchmarks, and he says, will the S&P keep up an 11.25% return for the next 10 years? There's other questions in my mind around, would it be different if the comparison was with MSCI World, or if the base year, Ludo, was different from 2006?
Ludo's very good at telling you how alternative benchmarks will adjust some of these performance evaluations. But my personal view is that if you just look, the Federal Reserve has over $4 trillion on its balance sheet right now. Before the financial crisis, it had around $800 million on its balance sheet. That money has, well, I don't understand how you get that kind of money out of the economy, but you don't do it and have an 11% return on the S&P 500 going forward. It just can't happen. So liquidity is going to come out of the economy from central banks, and when that happens, I can't imagine that the liquidity premium that private equity will command over public markets it must go up. It simply must.
I'd like to say, so the 10, 11% of the S&P over the last 10 years is very important to know that it's not a historical aberration. The US stock market in about any decade, since as far back as we can go, earned about 10% a year. And it goes for like any stock desires. You can go like, the easiest data to get is Ken French website. You go there, you download all the US stock market by desires, by whatever you want, and you will see the 10% average return about that every like 5-10 years that you take, you will get around 10%.
So the historical aberration is the degree of liquidity that's been pumped into the market.
Yeah, that's right. That's right. That's right. I come to the liquidity. So the 10% has not been exceptional. Going forward, it's almost impossible to get it because of the level of prices. That I agree. But the last 10 years at 10% is not something exceptional. It is important as well to remember that the S&P didn't do very well before 2006, but small cap and mid cap did also 10, 11% a year before 2006. So one thing I emphasize in this paper is that this 2006 is not really like a miracle year. If you would take a small cap, mid cap benchmark against private equity, even in the paper by David, where they had data from the 80s, early 90s, the only paper that has very old data on private equity fund returns, when they chose a benchmark that was a bit more like small cap and mid cap, the premium was already a lot smaller. So it is important that, you know, if we compare to small cap, mid cap, private equity has always been in the ballpark of these guys. Now, if we take the S&P 500, the MSCI World now, etc., we will get a bigger spread. Going back to liquidity, we would need to understand a lot better what this liquidity premium is, because it's a bit of this mysterious thing. My understanding was an LP was supposed to get a liquidity premium because they give this capital on demand at short notice to the GPs. And so if that's the situation, then the GP should just give a piece of cake as a reward for this liquidity provision to the LPs. Now, this cake was there. The GPs did extremely well over the last 14 years. They generated 20% return gross of fees. The problem is they kept the entire cake. So saying, well, they didn't give any liquidity premium to the LPs because of QE. No, they didn't give premium to LPs because of contracts that were written that way. Now we can blame the LPs and say they shouldn't have given such generous contracts. But that's, you know, the money was there. It's not like the money was not there and so they couldn't give it. The growth of these returns in private equity over the last 15 years has been very good. It's just about
I'm sure participants agree with me that both of you are extremely passionate about this topic, and we can go on and on the whole day. There are a few other questions that I want to touch on. David, you had made reference to issues around operational changes that PE firms make to portfolio companies. Becky Pritchard says you completely ignore the role of financial engineering and low tax rates in inducing returns. She asked, how do you address this? There's also a question around, you know, how do you differentiate between good and bad managers? There are lots of questions, so yeah, I hope you can keep your comments short so I can get through many of my questions.
I'll try to be brief in response to Becky's question. I mean, I think I don't mean to ignore the fact that there is financial engineering in this market and that it generates returns. And I think that the evidence is clear that the private equity funds that generate the stronger performance for their limited partners are the ones who more heavily engage in operational engineering, not financial engineering. Mm-hmm. And if you look across the market cycle, what you see is that, you know, it gets easier and easier to apply financial engineering when credit conditions ease up, and you know, and those are disproportionately the deals that don't do as well. So I think there's no question that there's a combination of operational and financial engineering. I think the more holistic view is to recognize that rather than seeing them as alternatives, they're complements. Good financial engineering accompanies good operational improvement to strengthen incentives. That does not at all mean that that every piece of financial engineering is good. And in fact, I think you should ask yourself, you know, you can go out and buy financial engineering in the investment banking marketplace. That should not command a high premium. What should command a high premium is going in and doing the hard work of fixing things that are broken. That often is best done when accompanied with financial engineering because of the tax shields it generates and because of the discipline it generates. But I don't at all mean to sugarcoat that. So I appreciate Becky's question.
Ludo and David, do you both want to talk about whether there's a difference in spread between great managers and below average managers? Javier Joseph from EY asked that question about the impact of the quality of people.
Ludo, go ahead.
The issue is that we give a lot of freedom. We are fairly liberal in the way people can present their track records and the like in private equity. There is basically, it's open bar. So everybody's top quartile, everybody's amazing, everybody like has the shiniest thing. And, so in mutual fund research, we had complained for a lot of time about like survivorship bias, people incubating mutual funds, doing all kinds of things like to window dress their track record. In private equities, it is open bar. So what that means is that everybody looks great. And so an easy escape to the facts I've just presented is to say, but I invest only in top quartile guys, so I should not really think hard about the issues that are here on the table. And I think it's not true. Like, not everybody is top quartile. You're not investing in only top quartile managers. And it's not that easy to like detect the next top quartile, etc. Just like it's not easy in the stock market. And so we should not avoid the important questions by this illusion that, oh, I'm above average, so that's not about me. We've had that for 40 years in mutual funds, where people kept on showing that the average active mutual fund was underperforming indices. People kept on saying, but I invest only with a good guy, so it's okay. I think, again, we should take these facts and say there is a problem here, and let's address the problem by thinking of a model that will be more resilient, better designed, etc., rather than saying it's okay, let's ignore this side issue, and because I invest only in the best half. So
I'm very sympathetic to what Ludo's saying here. In spite of how it might appear to the contrary, I think first of all, there is enormous variation in the average performance of different funds. The spread in performance is as I said, it's orders of magnitude larger than what you see from public equity managers. So what that means then is if you have an opaque, ambiguous reporting system, as Ludo calls it, an open bar, then then there's tremendous scope to hide mediocrity behind a veil of apparent success. There's no question about that. I think that the entire industry, GPs alike, would be better served by having a more transparent reporting system. But I think in truth,
transparency and disclosure, the impact of this work.
Well, and there's a lot of work that's going out there in the market to push for this. I mean, it's it's not like we're living in the darkness. There's a lot of work going on, and there's lots of people who are very sophisticated in the way they ask for performance data.
I have a few more minutes, and I've got two other types of questions that I'd like to, and I'll just share the two types. One of them is on regulation. It says, is the regulation of PE strong enough globally? I'd like both of you to comment. The second is really around reference to value and society. I think Amy Chan from Brazil asks about, what is, really some thoughts about value to society. And Alan Mack from our Facebook platform really says, okay, we are in COVID times. How do we balance the new model of profit-driven corporations against a more environmentally and people-centric type of approach for PE funds? So those are the two questions I'd like both of you to take. We've got basically 2 minutes. And you can take them in your closing remarks, which I'll give you an opportunity to.
Let me take mine in my closing remarks, because actually that final question you asked is something that I wanted to touch on in my closing remarks. I do think that private equity has an important role to play in increasing the size of the pie for a wide variety of stakeholders, and I want to kind of speak to that at the end. But
okay, what about regulation? Ludo, do you or David want to say something about regulation in the last minute that we have?
I think it's an emergency to have level playing rules, and the argument of saying some people are doing that already and so on. One should not forget that there might be a causality between people who have been shouting for 15 years and the regulation that has occurred. And so 15 years ago, when I was talking about hidden fees in private equity, I was shouted at because I was an enemy of the asset class, and it was terrible what I was saying. It was all wrong, etc. I took 5 years to do the research, documented all the hidden fees, etc. And then by miracle, the SEC came out and then shouted. And then now when you ask people, they say, oh yeah, that was something in the past. It was not very good, but it's behind us now. So it's all good, right? So it's fine to say, it's all good, etc. But we should not forget that this came because some hard questions were asked and because there was tough love at the basis. Until people are still using IR, I said I will stop shouting, but I will be upset. I think we are still a very, very long way for having satisfactory level playing field. We are nearly there in the mutual fund world. We will have to converge to that. It should be forbidden for somebody to come on stage, like David and I witnessed in a conference recently, somebody coming on stage and say, over the last 30 years, we had 39% return in our firm. And that's why we raised the largest private equity fund ever, period. It doesn't exist, your 39%. This is pure BS. This is what you should be telling MBAs to not do. And somebody should not be allowed to say things like this in public or in writing in SEC filings for the matter. So we are very, very far away from a satisfactory situation. And the usual answer to say, LPs are sophisticated guys, so it's all good. Let's just turn a blind eye to all of this. I think that's the wrong attitude. We need to ask very hard questions. And the model is very, very costly to run. And if the interest rates are lower in the future, the expected returns are lower in the future, like David said, the cost of the model is going to be more than ever a very important factor. We need to think about how to run this model with a better cost structure. And we will not be asking this question seriously while we are still believing in alpha close.
David, can I start with you in terms of your closing remarks? Because we're now, I can't believe we're almost towards the end of this. I'll need to decide how we manage the rest of the questions that I didn't take. So can we start with you, David, with your closing remarks, and then Ludo? And then I will bring in Chris Flood to give us his perspective, since he's been listening over the last 45 or 46 minutes. David.
Sure, thank you. And again, I'll conclude where I started by thanking both of you for having me here. My conclusion will touch on some of the questions that were just raised in the previous round. So I want to conclude by saying that private equity has not looted our savings to create billionaires. It has created billionaires for sure. You cannot argue against that. But it has created billionaires by enriching our savings, and it's done that by introducing radical change in the way business is conducted. Private equity executives, on average, are not thieves stealing our savings. They are the midwives of technological disruption. But, I want to be very clear here. I am quite sympathetic to many of the arguments that Ludo's making. Every time a billionaire is minted, it feels like the world has gotten just that much more unequal in terms of the distribution of wealth. And this raises basic questions of human fairness and human decency. And I think Ludo is 100% right to raise these questions. But I want to be clear, minting billionaires in private equity is not the cause of inequality, it is the consequence of it. Stopping it by blunting incentives will not bring about a more just world. Instead, we have to address the causes of inequality, not the consequences if we want to change them. If we want a more fair and more just world, we should not work to slow the pace of disruption. We should not blunt the incentives of those who are empowered to bring it about. We should work to make it more inclusive. Rather than blunt their incentives, the incentives of those who have created great wealth as a consequence of ushering in great change, let's make those incentives available to a much broader set of people. Let's attack the unfairness that Ludo is implicitly calling out by making the PE community more open to historically underrepresented groups, women, people of color, members of the LGBT community, heck, for that matter, people who don't have the Ivy League or Oxbridge stamp of approval. I think if we do that, instead of destroying the incentives that have created billions of dollars in wealth for society, let's apply those very same incentives much more broadly so that this capitalism on steroids model that private equity offers can be applied to an even broader set of economic problems. We know that people invest in that which looks like them. So if we can spread this model much more broadly, I think we'll get much more systemic change. Thank you.
Thank you, David. Ludo.
I haven't prepared closing remarks, but I'm gonna follow up on what David said. I think I'm not asking what David voted for, but I'm pretty sure where he would be on the political spectrum from that vision, and you will easily guess where I am from my counter view. I think fundamentally there is this, some people have a view that there is a pie out there that can just like magically grow, and there's some people who make it grow. They're like this wealth creator, they just make the pie bigger, and so then you forgive them. It's like, it doesn't matter, the pie can be bigger, and even if there's some problems in the pie, even if there are like some inequalities or things like that, it's okay, because the pie can grow bigger, and then the people who don't have much then will get a bit more, and so it will be all cool. I hope I don't paraphrase too much, but there is this view out there. My view is that there's probably some of that, but the pie is in my view quite fixed, and so we need to fix the pie. It's not like growth can just go on forever. Resources on Earth are limited. When a company's revenue grows, it came at the expense of some other things. Maybe people got more stressed out. There might have been some people in other companies that have been affected. There can be incidents on the environment and etc. So I don't think like there's this magic growth, and if we all have that, we would all be happier. I think, but that's not something that has been settled. I think it's a very important research question that we really need to think harder about. We tend to think in partial equilibrium, as we say in economics, about like if something is growing, then it's like magic. It didn't come at the expense of anything else. I think we will have to carefully think about that. This money that has been transferred to these people that didn't come from the sky, from something that they had generated. So then it's okay. It makes it okay. I don't think it's that. Did I misquote you, David? Because I see that you're moving.
May I have 15 seconds to make a small addendum? No more than 15 seconds.
I'll give you the 15 seconds.
I don't believe the pie grows magically. I believe it grows through hard work, and the way you get hard work is by giving strong incentives. That's all.
This is obviously a debate that will go on for a really, really long time. But I think that the more we talk about this, the more we reach agreement on how to do better going forward. Chris Flood, as I mentioned earlier, is a Financial Times person who has covered this industry extensively and this topic. So I'm curious to hear, Chris Flood, your perspectives, having listened to Ludo and David, and also based on your own work.
Oh, thank you, Arunma. Thank you. So I'm a reporter on FTFM, which is the fund management section of the Financial Times. And our role is to find the most compelling investment management related stories globally. Professor Ludovic has helped me with at least 20 articles, and there have been some of the most interesting and best read stories that I've written during my 10 years on the FTFM team. And it might surprise you, Arunma, that I've never actually met Ludovic in person. And we had established a productive remote working relationship before such arrangements became necessary due to coronavirus. So I'm hugely grateful to his help, his insights, his inspiration. But investors across the world owe a real debt of gratitude to Ludovic, as he's done more than anyone that I can think of to challenge the myths that the PE industry has so carefully constructed for itself. His work should encourage all investors to take a much more rigorous look at the role of private equity in their portfolios. One of the fundamental questions raised by Ludovic's analysis is whether investors are being treated fairly by private equity managers. Now, an answer to that question would not be complete without anyone taking a look at the risk warning that was published by the US regulator, the Securities and Exchange Commission, earlier this month, with a very direct instruction to private equity managers to improve standards. The SEC very clearly says that the private equity industry is failing in its fiduciary duty to its investors. It provides a lengthy, eye-popping catalogue of serious problems, including investors being overcharged for fees and managers failing to deal with multiple conflicts of interests. And it is essential to remember, of course, that these costs are ultimately paid from the pockets of ordinary retail investors. I look back through the stories that Ludovic has helped me with, and one of the first issues he drew my attention to in 2015 is the extraordinary fact that most US public pension plans have no record of how much they have paid in carried interest and performance fees to private equity managers stretching back over decades. This is an appalling failure of governance, and it remains unresolved. Ludovic estimated that the largest private public pension fund, CalPERS, had failed to disclose over a period of 25 years that had paid at least $5 billion in carried interest to private equity managers. And that revelation, when it was reported in the FT, led to a change of the law in California, whereby public pension fund managers are now required to provide details of all payments to private equity managers. CalPERS had to build an entire new reporting system to comply with these rules. It eventually admitted that it paid $3.9 billion in carried interest and that this was an incomplete figure, as some managers had simply refused to disclose how much they had been paid by CalPERS. This explodes the myth that the private equity industry's clients are sophisticated investors, who understand every detail of the contracts they sign. It also further emphasizes the fact that the transparency and disclosure standards of the PE industry are wholly inadequate and in need of serious reform. We all know about the problems with IRRs, and it's difficult to know if other performance measures are also being reported fairly. Willis Towers Watson, the world's largest advisor to pension funds, is able to demand that private equity managers provide details of fund cash flows, but this information is not in the public domain, and private equity managers are determined to keep it that way. Change surely has to come, because the US government has just provided permission for personal pension plans, 401k plans to invest in PE. There is simply no way that ordinary retail investors are going to be able to understand the performance metrics that are used by the private equity industry, and this will eventually lead to a mis-selling scandal. Asset managers are supposed to help allocate capital efficiently. Professor Robinson argues private equity helps to make companies better. PE is the only part of the investment industry that directly causes companies to collapse. There's a growing list of companies that have been acquired for billions of dollars by private equity managers, which have collapsed mainly because GPs load them with unsustainable debt, levels of debt, but not before lining their own pockets with dividends. Even the most aggressive short sellers amongst hedge funds are rarely able to cause the collapse of any company that they target. But this is now a routine feature of the private equity industry. It raises serious questions about GPs' expertise as corporate stewards and their relationship with the wider community of stakeholders in companies they control, including employees, pension beneficiaries, and suppliers. Just very quickly, during this current crisis, every PE manager has maxed out their credit lines, their subscription facilities. And the ILPA, the main association representing investors, had just issued another appeal for GPs to provide proper reporting about subscription lines, which of course are paid for by investors. This again highlights the need for changes in behavior. Big PE managers have lobbied very hard in Washington for their companies to be given access to bailout funds organized by the US government. They've given no reassurances in return that they will attempt to treat investors more fairly, and the top executives.
I think we need another session to cover many of the issues that you have raised. So because we're almost coming to the hour, and I would like to be able to close and talk about the next session. So can I give you another 15 seconds just
and we'll just say, and in return for the government assistance, the top executives have not provided any promises that they will scale back their efforts to enrich themselves. And just to conclude, finally, I think investors again across the world owe their thanks to Ludovic for the work he's done, and they really should club together to provide new funding to Oxford University's Saïd Business School, so he can assemble an entire team of researchers to continue his invaluable investigations into PE.
Thanks, Chris Flood. This has been an amazing conversation with a lot of passionate arguments. I've heard tough love, minted billionaires for the collective benefit of society, governance, benchmarks, measurements, skill and luck, financial engineering, operational engineering. But this is such an important topic. And I think the value of a good conversation is that you still want to continue the conversation, but I have to close here. So let me start by saying that there were a lot of questions, excellent questions that participants had for the protagonists. So let me start by suggesting that David and Ludo, that you plan to answer these questions and that we should probably post them online so that the community can hear and your responses to these questions. Very, very valuable questions.
Only if we have an incentive fee.
The incentive fee is your next book.
Let's negotiate that. I've done very good negotiations before, so let's negotiate.
Any good answer is like 20%.
The love of society is what I will pay you. What you measure indeed matters, and this paper and the debates, in my view, has helped us better understand this industry. It's given us valuable insights. So let me first say a sincere appreciation to our two protagonists, Professor Ludo of Saïd Business School, University of Oxford, and Professor David Robinson, Professor of Finance at Duke University. Your debate has enabled a better understanding of the economics behind fees, carried interests, the issues around the PE industry. I am grateful, Chris Flood, for the perspectives that you've added. Additional areas that we need to come debate, including the governance around pension funds, endowments, and the like. Let me also just say a big thank you to all of you who have joined on various platforms, Facebook, YouTube, Twitter, LinkedIn, and via our website at Saïd Business School, University of Oxford. Let me also use this opportunity to give you the details of the next edition of our Leadership in Extraordinary Times series. It will take place on Thursday, 2nd July, from 12 noon to 1 p.m. British Standard Time. It will be a conversation between our Dean, Professor Peter Tufano, our distinguished guest, Mr. Mo Ibrahim, who, as many of you know, is founder of Celtel, a disruptor for the telecoms industry, and also the founder of the Mo Ibrahim Foundation that is focused on governance. Also, Professor Wale Ade Bawimi, Professor of Race Relations and Director of the Oxford Africa Studies Center. The three of them will be discussing the topic, putting governance at the center of Africa's development. Remember, you can access recordings of all editions via Saïd Business School's website and its YouTube channel. This conversation has to continue because it's such an important topic for society. Thank you all for joining us today, and I look forward to you joining us from 12 noon to 1 p.m. on Thursday, 2nd July.